Good morning everyone, welcome to this market wrap up this Saturday 18th of June 2022. We'll start here on the Dow Jones Industrial Average, and you can see this week we had this large gap to the downside on Monday. Tuesday down, Wednesday up, Thursday continued to the downside, and Friday we finished a little bit down, minus 1%. So as you can see, this wave 3 of 3 has very strong momentum to the downside. Wave 1, wave 2 possible, so we're in wave 3 of 3 now. So I'm expecting this to continue lower and lower in the weeks ahead. It's already reached my target area, 29,795 to 29,550. I'd expect that to continue grinding lower, 28,323 being the next level, and then breaking that 25,357.90 being, I guess the main level I'm watching for this wave 3 of 3 to end. So you measure that, got another 15% downside to go, and breaking that as low as March 2020 bottom. So we go now to the S&P, much the same, gap lower on the Monday, Tuesday down, Wednesday pullback, Thursday down, Friday up 0.22 of 1%. So also you can see significant momentum in this wave 3 of 3. First level I'm watching here, 0.5 Fibonacci retracement on this monthly, wave 5, 3,500, breaking that, 3235, 3195 I'm watching, which is 0.618 retracement, and breaking that level 3 as low as March 2020 drop. Now, regarding people who are still heavily invested in the stock market, if we look here on the investor sentiment survey, you can see here people are still quite considerably greedy. And while they're reporting that they're fearful, their actions aren't matching, and they're still heavily invested in ETFs that are basically invested in the indexes. So while they say it, their actions aren't matching. So, there's still not much fear in the market. If we look here, this is Elliott Wave International, which I'm a subscriber to. This is today's update. You can see no panic. And they determine that by the spread between the 1 month future contracts and the 3 month on the VIX, which is the volatility index. You can see here, look, back here in March we were much higher fear than we are now, even though we're much lower. And you can see back in October of 21, even back then we were quite high fear level. So, that basically means that there's not much panic showing in the market. And once we get this wave 3 of 3 really starting to kick in, that will significantly change. And you'll see a lot more panic and people actually taking action and selling and closing positions to take profit, or basically to save losses if they're already down. And the other thing is, you need to, as we've mentioned before, currently we are 23.5% down for the year. Now if you're one to wait for the technical bear market, a drop of 20% minimum before you've taken action, it basically means that you've only started to think about selling since we've broken here this week. Now, with technical analysis, if you were to see this here, we confirmed a lower high back in the second week of January. So at that point, you're saying, that's interesting. This bullish trend hasn't made a higher high. So at that point, you're watching for a bit further confirmation. We break 1, 2, 3 days, breaking this previous low, confirming a lower low is broken. Lower low here, but we confirmed it as soon as we broke this previous low. At that point, by understanding technical analysis and charts, which don't have the noise, you don't have to pay attention to the media and what everyone else is saying on Twitter and all sharing their opinions. It's quiet. It's easy to just remove yourself from all the noise and just look. Simple candlesticks, lower high, confirm there. I'm going to sell and take profits or close out. I actually currently am not invested at all in the stock market long term, passively. I took all my money out back in 2019. Yes, I did miss out on this gain. However, I'm okay with that. I'm still young, and as I'm a trader, I take options positions, looking for quick moves to the up or downside, over a few days and weeks. So I've made up with it by that, basically. So, I would suggest to you all, if you're someone that really thinks that, the market only goes up, yes it does until it doesn't. So you have to ask yourself, can you stomach further losses? Currently, we're down 25% almost. If we get as low as the 0.618, you're looking at another 12%. If we get to 0.786, 25%. March 2020, another 40% from here. So, can you afford another 40% potential to the downside, even 15 and 25? If you can't, sell. Sell now. Because this is a bear market. And it's a bear market because it's making lower lows and lower highs. Until we come up, make a higher high, confirm it with a higher low, it hasn't changed. Nasdaq, much the same, gap lower on Monday, quite significantly, about 3%. Tuesday down, Wednesday up, Thursday down, Friday up 1.24%. So looking for this wave 3 of 3 to continue. First level 10589 I'm watching, which is 0.618 Fibonacci retracement on the monthly, and then as low as 9,000 and below, possibly back past these March 2020 lows, which if you measure, that's only 5.5% more. This is 20, 40% more drop. And this will be a slow, gradual thing. What are we now? June, possible 6 months to a year before we've completed, or longer. Russell. Now the Russell's been leading this market. Grind lower. You can see it topped here 8th of November. We go back to the Nasdaq. You can see it topped 22nd of November. A couple of weeks later. The S&P topped this year January 4th. And the Dow Jones topped also January 4th. So the Russell's been leading. And the Russell is all small cap stocks, all small businesses basically in the US. Not like, big companies, Apple, Amazon and all those. And you can see, same thing, we gap lower on the Monday, down, up, down, up. So as we continue this wave 3 of 3, I'm watching the 1536, 0.618 retracement, 1225, and then as low as 966, 943, which is the March 2020 low, another 40 odd percent. So, and this is the thing with bear markets that really fool people. People think, yeah, we've fallen this much, that's it, we're going to have a big bounce now and make all-time highs. And they base that on the past years, that every low we've stopped at some point and made another big high. Low, come up, low, come up, low, come up, etc, etc. Now that works for 10, 12 years, and then it will trap people. It will trap people on the wrong side. So people who believe that the market will continue going up, and same with a lot of asset classes, property, Crypto as well. It only goes up. And unfortunately, most people think that near the top. That's why they get trapped, and then they start to lose and get their money stuck in the market, because basically they're just in denial and they don't want to take the losses off the table. At some point, it's a lot better just to lock in your losses to save further losses, and just sit in cash, sit on the sidelines and wait. And depending on your age, as we've discussed, you may not be able to afford a 40% loss to your portfolio if you're about to retire in the in the next few months or years, because we've already had a significant drop now, and if we continue grinding lower, which currently all the technicals are showing us that. And just to further emphasize this, if we have a look here, Elliott Wave International, which I'm a subscriber to, you can see there's no panic in sight according to the spread between the 1 month volatility index futures to the 3 month. So you can see here these little lines up, not much fear. Back here in March of this year we had much higher fear, and if you look, where were we in March? We were here. We've fallen much lower since then. So there's more fear here than here, which it's like, doesn't make sense, does it? But it just goes to show that the majority of market participants probably are expecting indexes to make higher highs this year and all-time highs again. So and you can see back in October of 21, same thing, much higher reading on the volatility index compared to now. So as this wave 3 of 3 grinds lower, volatility, expect that to spike much higher. And if we have a quick look, see we get much higher this Monday. We've sort of stayed around that range. Coming into the Fed announcement, because this week we had a Fed rate hike by 75 basis points, which is quite significant. They've also said that in the coming months they'll be expecting to raise interest rates continuously 50 to 75 basis points in the coming months. So, to try to basically get on top of inflation, which, let's face it, it won't happen, because unless they raise the interest rate to match the rate of inflation, it won't really happen. But if they did that, stocks will sell off a lot more compared to where they are now. And, they want to get re-elected, so there's a lot of politics involved. So it's sort of better to do things in a slow, sort of orderly fashion to sort of fool the majority of people into thinking that they're trying to help and do the right thing. So, as this wave 3 of 3 progresses, volatility you'd expect to spike much higher back to this March 2020, 85 and beyond. If we have a quick look now at 10-year yield, you can see this week we had this significant move higher towards the end of last week and this week, and now into the Fed meeting we've sold off a bit, quite significantly. Got to the targets I was looking for and beyond, actually, and going into next week I'd expect this to go up to 3.65% to complete before we get a big reversal and a big inflow of funds into the bond market for safety as this wave 3 of 3 progresses. So it sort of makes sense. Market sells off, people start to act and panic, they go into safety, into bonds, which are offering a small percentage return, 2, 3, 4%, which is much better than negative 30, 40, 60%. The long bond, which is the inverse, you can see here we had this pullback this week, back up to this area that I had marked out. Now into next week I'm expecting this to move back down. If we get a break of 132.16, we're going to 130.01 and possibly lower before we get a significant pullback in bonds in primary wave 2. If we look at the ETF iShares, which is BlackRock ETF of bonds, you can see we had an inflow on the 16th, close out the week with a doji. So following on from the long bond, will we see this come down next week to around 105 before bottoming, before we get a significant move to the upside? That's what I'm expecting and waiting for currently. And until basically, if we were to come up here and make a new high, then that's ruled out for me. But, currently I'm watching for a continuation because we haven't seen that. So the probability is still for bonds to sell off. If we now look at gold this week had a move to the upside, wave 1, wave 2 pullback. Going into next week I'm expecting a further drive down for wave 3, 1765 to 1750 region, then a pullback for wave 4, then wave 5, 1715 to 1699 and below. Silver much the same, wave 1, wave 2, wave 3, drive through these levels next week down to 2060, and then wave 4 and 5 looking for silver to go as low as $19 and $18.60. Quick look at the dollar. This is the DXY, so we've driven higher, sold off in line with the bond market this week. I'm also expecting this, now that this pullback looks possibly to be coming to an end, for the dollar to continue higher, up as high as 106.42 and possibly higher before we complete that and we get a dollar sell-off and a rise in bonds basically as the stock markets move lower. So that's it for now. I'll do another update in the coming days for the week ahead and we'll look at some other markets. But I hope you enjoyed that, and look, really reflect and think about basically your current financial position at this point, and if you're heavily invested in any market, we're in a bear market currently. So, are you in denial? Are you thinking that we're going to make new all-time highs? What's the reality? The reality is we're down over 20% in all markets currently, all indexes. So 100 grand, you're down 20 grand. Can you afford another 20, 30, 40 grand in losses? If you can't, even take half of your portfolio out, sit it in cash, sit on the sidelines, because you yourself will know if you're very emotional. Usually if you're very emotional and you're fighting against it, you're not positioned correctly. So it's much better to be in a calm, neutral state, and to be in that state, if you're positioned correctly, it goes a long way. And that's, for me, how I know that I'm following my logic and what the charts are telling me, rather than what I want, and what you hope for. So anyway, guys, hope you enjoyed that for today. Until next time, take care and see you in the next one. Cheers.